Our client wants to invest $10 million in Lending Club loans. Lending Club advertises returns in the 5 to 7% range, which sounds attractive compared with savings accounts or other low-yield options. But these are unsecured personal loans, so the return is only attractive if default risk is controlled. I analyzed 7,151 Lending Club loans from 2015, limited to 36-month loans used for credit card debt. The goal is simple: understand what drives defaults, and decide whether the client can invest with a practical screening strategy instead of choosing loans blindly. The headline recommendation is yes, invest, but only with strict rules. In the historical data, the full loan pool had a 16.9% charged-off rate. A conservative screen reduced that to about 7% while still leaving $19.2 million of eligible principal. First, the default reality. Most loans in the dataset were fully paid, but a meaningful share were not. Out of 7,151 loans, 1,208 were charged off. That is 16.9% of the sample. This is not a small tail risk. If the client invests randomly, they start with nearly 1 in 6 loans ending in default. The workbook also shows that the weighted payment return proxy for the full pool is negative, about -5.5%. That proxy is calculated as total payments received divided by original principal, -1. It is not the same as a full investor yield calculation, but it is a useful warning sign. The advertised coupon does not automatically become realized return. The good news is that defaults are not random. They follow patterns we can screen for. The first pattern is interest rate risk. In peer-to-peer lending, higher interest rates are supposed to compensate investors for taking more risk, but the data shows that the riskiest rates can overwhelm the extra coupon. Loans below 8% had an observed default rate of about 7.8%. Loans between 12 and 14% already rose to 23.7%, and loans above 18% reached more than 50% default. That means chasing the highest rate loans is not a free return strategy. It is a risk concentration strategy. The practical insight is to avoid the steepest high-rate bands. In the Excel dashboard, the recommended screen starts by keeping loans below 12% interest, because the default curve becomes much more punitive after that point. The second pattern is borrower profile. The available fields do not include every underwriting variable we might want, but they still separate better and worse risk. Lower-income borrowers, especially those below $40,000 in annual income, had an observed default rate near 28%. Renters had a higher default rate than mortgage borrowers. Verified borrowers also looked riskier than not verified borrowers in this sample, likely because verification can be triggered by riskier or more complex applications rather than being a simple quality signal. The point is not to reject a borrower based on one label. The point is to combine signals. Borrowers with low income, high revolving credit use, and many recently opened accounts have less repayment cushion. That combination is exactly what an investment screen should avoid. Now we combine the findings into a simple investment filter. The rule is intentionally transparent. Interest rate below 12%, revolving utilization below 70%, annual income of at least $60,000, and no more than 4 accounts opened in the past 24 months. The screen is not trying to maximize every possible dollar of coupon. It is trying to build a portfolio that survives default risk. Starting with all loans, the observed default rate is 16.9%. After the rate screen, it drops to 11.3%. Adding the revolving utilization screen brings it to 10.8%. Adding the income requirement brings it to 8.5%. The final recent account rule brings it to 7.0%. Importantly, the final pool still has $19.2 million of principal available, enough to fund a $10 million allocation. This slide shows how the Excel workbook supports the decision. The dashboard is not just decoration for the presentation. It is the audit trail behind the recommendation. It shows the baseline default rate, the recommended default rate, the eligible principal, and the return proxy swing. It also contains the chart data behind the interest rate analysis, borrower segment analysis, and screening funnel. For the client, this matters because an investment committee needs to understand why a rule exists, not just see a model output. The Excel file can become the starting point for an operational checklist. Pull current loan listings, calculate the same screening variables, exclude loans that fail the rules, then allocate across the remaining eligible pool. The key idea is disciplined selection, not blind exposure to the entire platform. My final recommendation is to invest. But do not invest blindly. Lending Club can be a reasonable opportunity for the client only if the loan selection process is strict and repeatable. First, automate the screen. Interest rate below 12%. Revolving utilization below 70%. Annual income at least $60,000. And no more than 4 recently opened accounts. Second, pilot before full scale. A smaller staged allocation can validate that the historical pattern still holds in live selection. Third, monitor quarterly. Track realized payments, defaults, and whether the screening thresholds need to be recalibrated. The bottom line is that the 5 to 7% promise is not something investors should simply trust. It is something they can work toward with data-driven loan selection, risk controls, and ongoing monitoring.